You don't borrow money from a bank. At least, not in the way most people think. When you sign a loan agreement, nothing is taken from someone else's savings. No vault opens. In that moment, new money quietly appears. Because if money can be created that easily, the obvious question is, who's actually in control here? And why does this matter more right now than ever before? Let's slow this down. A car. You assume the bank checks its reserves, sees if it has enough money, and then lends it to you. That story feels logical. What really happens is much stranger. The bank looks at you, decides you're trustworthy enough, and then types numbers into a system. Your account balance goes up. That's it. The money was created at the moment the loan was approved. This isn't a loophole, and most people never realize it. Every time a bank issues a loan, the total amount of money in the economy increases. Every time a loan is paid back, that money disappears. Money today isn't printed first and lent later, it's lent first, and only exists as long as the debt exists, which means debt isn't a side effect of money. Debt is the foundation of money. Now let's walk through this step by step, without jargon. When a bank gives you a loan, two things are created at the same time. An asset for the bank. You owe the bank money. That promise is valuable. Your loan becomes spendable currency. You use it to buy a car. The money moves through the economy, but it all traces back to one thing. This is where it starts to feel a little absurd. Most people think banks are limited by how much money they have. In reality, they're limited by how much risk they're willing to take. If banks stopped issuing loans tomorrow, the money supply would start shrinking. Businesses would struggle. The economy would slow fast, but because credit stopped expanding. That's why central banks panic during crises, not because prices fall. In 2008, this system almost collapsed. Banks stopped trusting each other. Money creation stalled. They didn't just save banks, they saved the mechanism that creates money itself. And they did it because there was no backup system. Now here's where the story gets uncomfortable. People are told governments control money, that central banks print it, that policymakers decide how much exists. That's only partly true. They set interest rates, they adjust rules, but they don't decide who gets new money first. Banks do, and banks choose where that money goes. Homes. This is why asset prices rise faster than wages. This is why housing becomes unaffordable. This is why financial markets inflate, while everyday costs squeeze people. The system rewards those closest to credit creation, and quietly punishes everyone else. Now let's talk about the math nobody likes to mention. When you borrow money, you must pay back more than was created. Principal plus interest. Which means, system-wide, not everyone can repay without new loans being issued. Old debt requires new debt to be paid. But it does mean the system requires constant expansion. Slower growth creates stress. This is why too much debt is never really fixed. It's rolled. Now contrast this with how people talk about money. We're told to save it. Meanwhile, the largest amounts are created with a keyboard and a risk model. It's not a conspiracy. It's just not explained clearly. Money isn't a thing anymore. A liability moving through the economy wearing a friendly name. So the next time you hear about a money shortage or tightening, understand what's really being restricted, not paper. It's permission to create new debt. If money is created by debt, who is the system really designed to serve? Because that answer explains far more about the economy than any headline ever will.